Another strategy that is used by value investors is contrarian investing. In this learning objective, we're going to look at the approach to contrarian investing and reconcile evidence regarding contrarian value investing with the momentum investing that we saw previously. With respect to contrarian investing, you begin with the proposition that markets overreact to different news that's released by firms. So if we have market overreaction, what that means is that price will move in a particular direction, but will move too far beyond fundamental value, and there should subsequently be some form of mean reversion back to fundamental price. Where we see overreaction, what we should see is that an investment strategy that buys stocks that have done well recently should actually then underperform in the future when that mean reversion takes place, and vice versa, stocks that have done poorly will actually mean revert and do well in subsequent periods of time. So, as I've said, the idea of contrarian investing is based on the notion that investors underreact. Hence, it is grounded in an investment philosophy where markets are less than perfectly efficient and that there are behavioural biases. Now, there's quite a lot of evidence that supports this notion that markets overreact to news. For example, studies that have looked at markets over a long period of time, so over periods of many years, have shown negative serial correlation. So, for example, when markets did well over the previous 5 years, they tend to do poorly over the subsequent 5 years, and vice versa. Similarly, when we look at individual stocks, we find similar effects over these long windows. So a key question with contrarian investing is to ask how that actually reconciles with momentum, which is what we looked at last week. But it's important that the two actually go hand in hand, because last week we spoke about momentum investing as being an intermediate horizon phenomena. That is, we look at returns over the past 3 to 12 months, and then we invest for the subsequent 3 to 12 months and rebalance our portfolios over those periods with a maximum rebalancing time frame of once a year. With respect to contrarian investing, we look over longer time horizons. So we might be looking at, for example, a 5-year period as opposed to a 1-year period. And we might recall last week we said one of the justifications for momentum was underreaction to news and subsequent overreaction to prices. That overreaction to prices, which causes the intermediate term momentum, should over a longer period of time of say 5 years mean revert, which actually provides a justification for contrarian investing. So the idea behind contrarian investing is actually justified with several academic studies. So DeBont and Taylor, for example, looked at portfolios of stocks that have done well over a previous period of time and found that they actually subsequently do poorly, where stocks that have done poorly over a period of time subsequently do well. So these studies of contrarian investing look at portfolios for the 60 months following the portfolio formation. And as I said, that's a key point of difference from momentum, which looks at a period of 12 months. So to chart the evidence regarding contrarian investing, here we have the performance of past losers and past winners across time. And we can see over these long time frames of 60 months, past losers tend to do really well and past winners tend to do really poorly. So there's quite a lot of evidence supporting contrarian investing as an investment strategy. Therefore, if you're thinking about this approach, some important tips for success. First of all, it's important the investor has self-confidence and clients that believe in you, because this is an investment approach that basically involves going against the market and going against the herd. It does require patience. Okay? It's a long investment period. You do need to hold for 5 years, and it can result in short-term volatility. So while on average, contrarian investing does tend to generate profits, over some short-time horizons, it can have big drawdowns or it can perform poorly. And also, like any trading strategy that moves away from passive indexing, it's important to watch out for transaction costs and taxes that might be incurred.